Hi, my name is Carrie Larson, and today Jessica Mason and I will be discussing our financial analysis of Nike and Under Armour. First, let's look at their shareholders. Both companies have very similar shareholder breakdowns. 84% of Nike is owned by institutions and mutual funds, while 77% of Under Armour is held by institutions and mutual funds. They have a lot of the same institutions and mutual funds in common, but Under Armour will be favorable in this position because Under Armour does not have a direct shareholder that owns a large portion like Nike does. Since Nike has a direct shareholder that owns a large portion, this could create potential agency problem, and they would have a lot of input into the company, which could skew what the company actually does. Therefore, because of Under Armour's diversity, it is better.
Next, we will talk about debt. Do they care about the cost of capital? The advantage of debt is that it allows them to finance for new equipment and new buildings, land, and more labor. It allows the company to take out the required amount to keep their business afloat and to fund for the different aspects within the company. By paying off the debt in a timely manner and installments larger than what they are required, it allows the company to be in a good standing, which will attract more investors. However, the disadvantages of debt is that they have to pay it back with added cost of interest. A lot of times the interest will take up more than a couple grand, which could be a huge burden for the company. If the company has too much debt and it cannot be paid off within a required amount of time, it would have to file for bankruptcy. It would also take away from the future earnings. This could be a huge burden for the company. So what is their cost of debt? The after-tax cost of debt is the debt times 1 minus the tax rate. So that for Nike, the debt is 3.46% and the tax rate is 24%, which comes out to an after-tax cost of debt of 2.63%. Under Armour has a debt of 2.44% and a tax rate of 39%. So the cost of debt comes out to 1.49%. Overall, Under Armour has a lower cost of debt, therefore they are more favorable.
To calculate the cost of equity for each company, we use the capital asset pricing model. To calculate the capital asset pricing model, we use the risk-free rate and the market rate in beta. The risk-free rate and market rate used for each are the same, but beta is what differs. Nike has a beta of 0.63, while Under Armour has a beta of 0.1. Nike's beta is slightly higher, therefore they take on more risk. Since Under Armour's is lower and they are less risky, that affects their cost of equity positively. Therefore, Under Armour has a lower cost of equity, and they are the better company in this situation. When looking at both companies' overall cost of capital, Under Armour has a lower cost of capital, therefore is the better company in this situation. It makes sense because before, their cost of debt and cost of equity were lower than Nike's, therefore their costs are low. This allows them to do more projects and really just have better capital structure than Nike.
Can WACC be lowered with change? Nike's WACC can be lowered by 0.7%, which will increase debt by 0.9% and increase equity by 1.95%. Under Armour's WACC can be lowered by 0.07%, which will increase debt by 0.25% and increase equity by 0.11%. Under Armour is closer to its optimal WACC than Nike, therefore Under Armour is better. Would changing the structure affect the company value? According to the results from our analysis, Nike would increase by $12.180 billion. Under Armour would increase by $706.88 million.
Adding more debt to each company would not create unnecessary risk. Both betas would still remain below market of 1, and they would barely increase at all. Especially Under Armour. Under Armour would only increase by 0.01. So therefore, Under Armour will benefit the most from this by optimizing their value and potential by only increasing their risk tolerance by 0.01. When comparing Nike and Under Armour to other competitors, they are all quite similar in their assets and equity and liability breakdowns. The only thing that differs is Under Armour. Under Armour carries a lot of cash, therefore they're very liquid and they're able to pay off their short-term debts, as you can see from the current ratio. Under Armour has the highest current ratio, therefore it is able to pay off the short-term debts. And this is because they are very liquid and carry a lot of cash.
Are their stock prices fairly valued? Both are undervalued. Under Armour is undervalued by $3.28, which is 4%. Nike is currently a better buy because it is undervalued by $5.33, which is 9%. The company that is more undervalued is the better buy. In conclusion, which company is better? Under Armour is better than Nike. It is favorable in 6 of the 8 categories. It has better capital structure, the lowest WACC, the lowest amount of risk, and is closest to its optimal point. Therefore, we choose Under Armour.